Welcome everyone. Today is day 5 of our agent training, and I just wanted to remind everyone that you can log into laerrealty.com/live. We are now getting to the point where the recorded videos will be on our YouTube LAER training channel. This is being live streamed, so we do have a chat section so that you can ask questions, and we will repeat those questions and ask them. I'd like to introduce Sarah Baer from Ross Mortgage. Ross Mortgage is our partner mortgage company. I can't tell you how wonderful they are to us with all the services that they provide us and the wonderful loan officers that they have. And Sarah is going to guide us through the importance of having a great mortgage company, helping you through the transaction, and 101 from the beginning to the end. So welcome, Sarah.
Thank you, Susan. I'm happy to be here today. Obviously, I love talking about mortgages, so this is like kind of a dream come true for me. For those who don't know me, my name is Sarah Baer. I do work with Ross. I'm a loan officer there. I've been in the mortgage industry about 17, going on 18 years now, which is insane. But basically, I've been through the processing, underwriting role, and now I've transitioned to a mortgage originator. So what we're going to talk about today is realistically mortgages, which I know might seem boring to you guys, but as real estate agents, there's a certain level of knowledge that I think that you all should hold yourself to an expectation to know. Certainly you shouldn't have the full vast knowledge of mortgages, but just a little bit of information is going to help you guys in your careers. So today, what you'll walk out of here with is a better understanding of the mortgage process, what type of mortgages there are, and the differences between some knowledge that most realtors don't really know, okay? So our expectation is just let's get a little bit more clarity on the process. The first thing that I want to talk about is pre-qualifications versus pre-approvals. This has been a very, very hot topic, especially within the last 12 months, I would say. There's a lack of knowledge on a lot of people's end, whether it be consumers, realtors, even mortgage originators, what an actual pre-qualification is and what a pre-approval is. Basically, a pre-qualification comes in, it's kind of a gray area, all right? Anybody can give a pre-qualification. I can give you a pre-qualification right now based on your name. Would I do that? Absolutely not. Okay. So what a the major difference is that when you have an offer that's written to you, or you're going out with your buyer, if they are fully pre-approved, that means that they have gone through the process with an originator, provided all of their documentation, and this is the most important step, is that documentation has been reviewed 100% by an underwriter. I would say in the industry right now, that is not very normal. Okay, so when you see a pre-approval, just know that that full 100%, those steps have been taken. So if you'll see here on the pre-approval end, actual income tax returns, actual bank statements, a hard pull from the credit bureau. The employment verification has been completed, which means that we're calling the employer, figuring out the exact pay, if there's bonus commissions, and actual liabilities from the credit report. And the most important step is that it's reviewed by an underwriter. Okay, that's rare today. It's rare that that's done. Is it done? Yes. Can we do that? Absolutely. Will it take another couple days? Yes. Okay. So what we're doing is right now we're currently giving pre-qualifications. Now this is where it gets a little hairy. Not every mortgage company does pre-qualifications as thoroughly as Ross Mortgage does. Our expectation as a loan officer, meeting with the consumer, meeting with the buyer, is that we're basically doing everything that's done in a pre-approval with the exception of having an underwriter review it. The reason this is because with Ross, we're very well-educated loan officers. We have the knowledge, we understand mortgages, so we know that if there's going to be an underwriting issue, we're going to see it in the upfront pre-qualification. So in the pre-qualification, we're doing the same things. We're meeting with the buyer, we're looking at their credit, we're looking at their documentation, we're looking at their bank statements, making sure that's completed. Don't get tricked though, okay? There's a million companies out there nowadays that are doing pre-qualifications based on somebody filling out an online form, plugging in information that's not correct, they're not verifying it, and it's spitting out a pre-qualification, okay? This has happened more times over the last 12 months than I care to see. And I have a lot of people scrambling and then coming to me at the last minute saying, Sarah, I had this buyer, they had the pre-qualification letter, and now that the bank is saying they can't do it, and it's because that information wasn't done up front, okay? How can you as realtors prevent this? Because you're not supposed to know exactly. A buyer comes to you, you're pumped. You're like, oh my God, you're pre-approved for $400,000. Let's go buy a house, right? Your due diligence, okay? The one step that you can take as realtors, call that loan officer, okay? If it's a loan officer that is in the middle of the United States, you can't get a hold of them, you're waiting on hold for 30 minutes, that should be a direct sign to you guys how the mortgage process is going to work, okay? You know, we all have our cell phones. We work on Saturdays, Sundays, nights. You know, I just did a pre-approval last Sunday for Laurie LaPlante out of this office, and the sellers called me because they didn't believe that I could turn around a pre-qualification on a Sunday night, which I thought was pretty cool. But I'm like, no, they're great. I've looked at their documents. I've looked at their bank statements, you know, but we had a very direct conversation. The seller was much more comfortable because I had talked to them about what I had done, and they got the accepted offer. So just knowing on your end, if the one biggest takeaway for realtors is to understand that if you do have a buyer that has a pre-qualification or a pre-approval, call the loan officer. Talk to the loan officer, ask them, has their credit been pulled? Have you looked at the documentation, the income documentation in their bank statements, okay? That could save you a lot of time and a lot of energy, and nobody's doing it anymore. I used to get calls constantly about people questioning, maybe it's because I'm so popular now, I don't know, but no, it's something that I've seen a real lack of in the industry. Any questions on a pre-qualification and what to look out for? Susan?
I'll be interrupting all that.
Yeah.
So I know you do online applications.
Yes.
But how did they send all that paperwork into you?
I go to their house and get it. They drop it off at the office. They scan it, or we have an online system that they can upload that documentation to.
Or they could come into one of our offices and have one of our admins scan everything for them.
Yep.
Okay.
Mm-hmm. It brings up a good point too about, the documentation, and which we will talk about later on. It's really such an integral part of the process. So when you have somebody that you're saying, God, I want to go and see houses, I want to look at these houses, you say get a pre-approval letter, and they're like, well, I've already sent some in, but can we just go look? And they're kind of dragging their feet on getting pre-qualified. That's a sure sign that they're not 100% in. Don't be fooled by that. I see a lot of realtors wasting their time when somebody doesn't even want to get their credit pulled and they think that they can afford a house, and realistically it just would never work out, or it's going to take them 6 months or 12 months or 18 months. Okay. The mortgage process in a whole. Okay, so if you see over here, nice and on the left here, this is nice, clean cut. This is what we're doing with the mortgage. Do the pre-qualification, the pre-approval, look for a home, blah, blah, blah. Do all that stuff. So this starting point and this ending point, there's really only 10 steps in the middle, okay? When it comes to mortgages, this is the starting point, this is the ending point. This is all the work that we're doing on our end. So when you see these checklists of, okay, yeah, you get pre-qualified, you find a house, you write an offer, you go to P&S, and then you're closing. Well, it doesn't happen that simple. There's, on any given mortgage loan, there's 240 to 320 steps that we're taking on our end. So if that gives you any type of sense of how insanely crazy it is and where it's all a big jigsaw puzzle and what we're doing to manage that and keep everybody happy, this is kind of a depiction of that. So when you don't know, first of all, you should never not know what's going on with your buyer or your seller, but just know this is kind of what's happening in the background of things. Of course, when you're taking the steps for purchasing a home, the pre-qualification, pre-approval, shop for a home, written offer. At the time that you're writing an offer, my suggestion for you would be to check in again with the loan officer. You're writing an offer based on certain dates. You're writing an offer based on certain purchase price and down payment. I got a call last night at realtor. The buyer was possibly going to put down 20%, but maybe 10%. And they said, well, we're just going to put down 20% on the offer. And I said, well, if you do that, realistically, you're putting your buyer in a legal obligation to put down 20%. So just know when a buyer wants to put down, or they're thinking 10% or 20%, always put the lower end. You can always put more money down and they're legally protected, okay? But if you go the other way, that can put your buyer in serious, some serious harm on the legal end. So just when you're writing the offer, the main things that you want to check in on, again, is the down payment, the date of closing, and the commitment date. Susan?
So can you explain that again? You can hear me okay? If they put 10% down on the two, for the total, the two escrow amounts, when they go to the mortgage contingency clause, they could put 80% mortgage, which would show that they're bringing another 10% to the closing. Does everyone understand that?
So you could do it that way. The thing that I don't want a buyer to get jammed into legally is that
they must
put down that 20%. Mm-hmm. So to be safe, on this specific one, the lower end was safer. Okay, so putting down just showing that they're putting down 10% and getting the mortgage for 10% down payment rather than the 20%.
So even though they might do 20, you'd say put down 90% financing in the mortgage contingency just to buffer them until they talk to you about exactly what they're doing.
Yes.
Interesting protection. Okay.
Mm-hmm. Of course, you get into a number of different things. With, is 10% enough? Is, but in this specific case, it was enough. So it's just, it's kind of gauging on every offer you're submitting. And that's definitely something that, like, as a loan officer, we walk through with you and can kind of figure that out. Obviously we all work as a team, so we're just trying to figure out the best scenario. Commitment date. This is a big thing for realtors. They think this commitment date is the end-all be-all of the mortgage. I could have a very clean file and all that's missing in my... So let me back up. Commitment date. Basically what that means is I have a buyer, you guys have a buyer, they're getting a mortgage. We review all of their documentation up front. We send it into our underwriting team. They re-review it. They come back with an approval, okay? That approval is going to be subject to certain conditions. It could be subject to the appraisal being completed, could be subject to the legal title work being completed, it could be subject to updated pay stubs. A commitment date is realistically, the date that I feel comfortable, the attorney feels comfortable, and the buyer feels comfortable with saying, yes, we can give you this mortgage, okay? You can get this mortgage, we can give you this mortgage as a lender. The attorney feels comfortable that their deposit is protected. I have seen it too many times where a realtor is pushing to send that commitment letter out when, let's say, we're missing the legal title work, okay? It's not the end-all, be-all, that commitment date. If the attorney feels like the buyer needs to be protected a little bit, we're going to wait for that title to come in so they can make sure that it's 100% correct, there's no legal issues, and that we're 100% moving forward. So if your commitment dates do get pushed out a day or two or a week, which really isn't common nowadays, especially on my end, I don't see it working at Ross, but I know it's out there. Just understand why that commitment date is being pushed out, and understand that it's realistically to protect your buyer, okay, or your seller. After the commitment date, after the first review, everything comes back in. The title, the appraisal, all the paperwork, we're sending it back to underwriting again for them to give a final approval. That final approval will come to the three glorious words we all know, clear to close. Once we have that clear to close, there's 2 different times that your buyer is going to receive numbers, okay? They'll receive an estimated number of how much money they need to bring to the table, and then they'll receive a final number. So usually when they get that estimated number, they're freaking out and like, oh my God, what's going on? Like they want to talk about it. And it's really just kind of an idea of what they're bringing to the table. So just on your end, if anybody, if your buyers are calling you, which they realistically shouldn't be, but if they do, because they have a good rapport with you or they're your friends or family, just understand that that comes in 2 different sections, okay? Now I'll just get into the different types of mortgages. Fixed versus adjustable rate mortgage. Basically, if you like to gamble, go into an adjustable rate. There's certain times where, so adjustable rate does get a bad rap. It's like the redheaded stepchild, but sometimes it does work. And basically the reasons that it does work is, in my opinion, in my history of doing this, it's for people who are looking to move into houses just short term. They know they're relocating. It could be a reload property where they're coming into Massachusetts and they know they're only going to stay for 3 to 5 years. That might be a great way to save them some money while they're here, is adjustable rate. I haven't seen anybody in the past 2 years looking into adjustable rates. It's kind of a dying breed. It does work in some cases, but nowadays with the rates the way they are, and because rates are so low, they're not as enticing to people, okay? So just going over some pros and cons of these. With a fixed mortgage, usually anybody who's purchasing a home, especially for the first time or their second time, they're getting a 30-year fixed mortgage. That's kind of the favorite mortgage that's out there. It's predictable. You know exactly what your rate is going to be. You can keep that rate for 30 years. That mortgage rate is never going to change, okay? Not to say their payment's not going to change, because taxes and insurance may go up, okay? But that rate will always stay the same, which flows into easy budgeting, easier to understand, and basically just retaining the option to stay in that rate if they wanted to. Nowadays, people who have even bought a year ago to 3 years ago to 5 years ago are refinancing their fixed rate because they're saving a point and a half, which is something that I've never seen so dramatically in such a short period of time. So with the fixed rates right now, that's going to probably be the biggest option this year. It's probably going to be the one mortgage that people are going to be getting into the most. An adjustable rate. Adjustable rates were very popular back in the early 2000s, and really, in my opinion, I think have a lot to do with why the financial crisis happened in 2006 to 2008, along with inventory and, houses, losing value. But the adjustable rate, what happens and how that's structured, okay, just to give you an idea, is that, say a fixed rate today is 3.875. An adjustable rate may be 3.625. Okay, so off the bat, you're saving some money. You're saving some interest, which in turn helps you in the short term, definitely. Maybe not the long term. With adjustable rates, there's different time periods. So how an adjustable rate works is you could have, they call them arms. So you could have a 1-1 arm, a 3-1 arm, 5-1 arm, 7-1, or 10-1. And what that first number means is the amount of time that your rate is basically fixed for. So that 3.625 that we were talking about, if you have a 5-1 arm for the first 5 years, it's going to stay at 3.625. So you would see how it would benefit somebody who's realistically only looking to stay in a house a short amount of time, right? After that 5th year, your mortgage could go up as much as 2%. Okay, so it's 2% every year. That's the most common type of adjustable rate mortgage. There's other crazy ones out there, but that's the one that we usually use. So at the end of it, so you'll see, at the end of 8 years, if you started at 3.99, your rate could go up to 8.99%. So you see how kind of, with the crash that happened, people couldn't refinance out of adjustable rate mortgages because there wasn't equity in their house. That is not an issue we're going to have to run into, at least for the next 10, 15 years. There's, the inventory's, you guys know, the inventory's low. Equity is rising. So it's, if somebody does come to you and asking about an adjustable rate mortgage, you can see it's kind of scary. You really have to be a gambler to use it if it's not something that you're really going to stay in the same place for only a couple of years. Okay. Any questions on an adjustable rate versus the fixed rate loan? Good.
I have a quick question.
Yes.
Is it always one-sided with the adjustable rate? Is it always going to lean towards the lender's side? And that's a huge difference over the course of 6 years. Is the adjustable rate never based upon the fact that the loan rates have dropped while you're...
That's a great question. Yeah, so I have friends right now that are adjustable rate mortgages that they're riding the wave because they started with the 6% and now they're down to 3%. So on the flip side, it could benefit you if so how the adjustable rate mortgage works, it basically goes off of the prime rate plus a certain type of margin. So it could benefit you if rates are low. Mm-hmm.
Thank you.
You're welcome. Conventional loans. So conventional loans are just your standard vanilla loans that basically every single, anybody that has a rather good credit score and has a decent down payment. Nothing's tricky. It's not a niche loan. It's really just your kind of standard run-of-the-mill mortgage. Down payments for first-time homebuyers as low as 3%. That's for every first-time homebuyer. And you're a first-time homebuyer if you haven't bought a home in 3 years. So if you sold your house 5 years ago, you've been renting or living with family, you're considered a first-time homebuyer.
I didn't know that.
Yep.
Can you repeat that again for everyone? Wow.
So if you haven't bought a home or owned a home, if you haven't owned a home within 3 years, you are considered a first-time homebuyer.
Interesting.
Thank you for clarifying that because that
Yes.
threw me for a loop.
Yeah.
That's amazing.
So what that means is there's a lot of first-time homebuyer programs out there right now. You're going to see them marketed. You're going to see them, people flashing lights about them. There's no federal first-time homebuyer program out there that's, giving anything other than what we possibly could give, right? The benefits of being a first-time homebuyer, 3% down is the minimum that you could put down, okay? The private mortgage insurance typically is a little bit lower as well. And there's certain first-time home buyer programs that we can fit you in that fall under this conventional umbrella, that the rates are much lower too. So that comes with digging in more to, say, a buyer who's looking at these programs. You might hear them, they're called Home Ready, Home Possible. If you hear that, that's a trigger word that they're a first-time home buyer, they're getting a better rate, their private mortgage insurance is much lower, okay? The Home Possible, Home Ready, that falls under the conventional umbrella, comes with a certain income max, okay? So right now, like around this area, I think it's about $60,000. They just per
couple.
per couple.
Oh, per couple.
And that's where we strategically go in and figure out, okay, so we have buyer A and buyer B, and they're married. Oh, I could use just buyer A and leave buyer B off of that because they make under $60,000 if they qualify. So there's certain creative, strategic things that we can go through and can figure out. They just lowered that amount within the last 4 to 5 months, so it really kicked a lot of people out of this. For the people that it works for, it's great, but again, that's for first-time home buyers that fit into that certain income potential. Otherwise, all first-time home buyers are 3% down. Okay. Private mortgage insurance. With a conventional loan, anything less than 20%, you're going to have private mortgage insurance. Getting ahead of myself, there may be ways to get rid of that private mortgage insurance with creative structures within the private mortgage insurance companies or within the loan process that we can definitely work on. Sometimes it works, sometimes it doesn't, but there's definitely ways that if it is less than 20%, say it's 15%, there may be a way that we'd be able to get rid of that private mortgage insurance. So private mortgage insurance can be canceled. There's certain mortgages that private mortgage insurance, even if you put 20% down, you're still having to pay private mortgage insurance. So with this option and with a conventional mortgage, you are able to get rid of your private mortgage insurance once you have 20% equity in your home. There's 2 ways out of it. 1 is you can refinance. 2 is that your private mortgage insurance can be canceled through your private mortgage insurance company. It requires 2 years on-time payments. Okay? So if anybody comes to you and is like, geez, I want to cancel, I think I have 20%, those are the 2 options that they can go through. Conventional loans can be used for second homes and investment properties. Second homes, there's nothing really crazy about second homes. They have to be single-family homes or condos. They can't be an investment property. They can't be a 2 to 4 unit property. Second homes only require 10% down. Okay, investment properties, no matter what, it's 25%. We're trying to figure out creative ways to get around that, but if it's investment property with, 2 to 4 units, 25%. Rates and credit scores. Anything realistically above a 740, your customer, your buyer, is getting the best rate. Okay, so that's kind of the top tier. Anything below 740 to 700, you're still in a great criteria. 700 and below, that's where I'm looking at different alternatives for your buyer. Okay, we're looking at different mortgage products. It may work for them that the conventional is their best bet, but it may not. Okay, how it affects your rate is that it comes in tiers. Okay, so if someone comes to me and has a 697, I'm cringing because they're 3 points away from that 700. But alternatively, another mortgage product works better for them. So it's realistically just looking at the different products and figuring out what works for each buyer. Income limits. The income limits they've become a little bit flexible on these, especially with conventional. Now we can go up to a 50% debt to income ratio, which means basically 50%. So you have your income, say it's $10,000, your debts that are $1,000. We could use 50% of your income to cover all of your debts in your new mortgage. Okay, we'll talk about that later as well. But it's become more flexible over the last year and a half, which allows more buyers to get into this conventional mortgage rather than using alternatives. Okay, there is, credit guidelines. Like I said, with a conventional, anything under 700 may be a great option, but we want to look at different mortgages as well, okay? Because it's going to be the rate might not be the best. The private mortgage insurance rate might not be the best. Reserve money needed after down payment. With conventional loans nowadays, they like to see a little bit of a reserve. So if you're buying a house and you have $20,000 in the bank and your funds due are $19,900, might be a little tough. So we just need a little extra padding. I wouldn't say we weigh too heavily on that, though, so it's not something that's really necessary. If you're buying a 2 to 4 unit, it's necessary, okay? But with a single-family home, conventional mortgage, like I said, it's pretty plain, it's pretty vanilla, it's pretty boring. There's nothing crazy to it.
We have a question.
Yes.
Can you say a few words about Ross exploring green mortgage products from Fannie Mae and Freddie?
Hi, Craig Foley.
I didn't say that.
So Ross Mortgage is actually coming out with, we're going to be rolling out 2 different green mortgage products probably within the next 3 to 6 months. And what these integrate is that if you've seen in the area, especially around Central Mass, one of the biggest things that we've been seeing is solar panels are popping up, right? And when you go to purchase a home, when a buyer goes to purchase a home, or when your seller is selling a home, the connotation is that there's no value to them, okay? But realistically, there's a ton of value to these solar panels. There's a ton of value to these mini split systems, okay? That realtors, buyers don't know how to put a price tag on that, okay? Because appraisers don't either.
Right.
So what this green program is going to do, it's both through, this falls under the conventional umbrella as well, is having appraisers that are licensed and knowledgeable about this to come into the home and actually place value on this. So on the selling side, it's going to get more money for your sellers. On the buying side, it's going to create more of, enticement that they're seeing those savings throughout the year.
So I'll comment on
Yep.
that. So the difference between leased and outright owned solar panels. The outright owned the leased ones are personal property. The outright owned ones add to the value, and that's exactly what Sarah's saying. But only an appraiser who understands that will give you that extra value, and should, and that's the appraiser that should be used on that type of property. It does add value to your home, which is an awesome thing for sellers.
Yeah, and people are becoming more understanding of that. A year ago, if I asked a realtor that saw solar panels, they tell their buyer to run. I'm like, what are you doing? It's crazy. But yeah, leased versus owned is also a great thing if you're coming across somebody that you're doing a listing presentation for and you notice solar panels, figuring out if they do lease them, what their terms are, because that's going to be passed on to the new buyer. And that new buyer has to qualify for that amount per month.
So I might as well put another plug in. So Craig Foley is our Chief Sustainability Officer for the company. If you go into Career Den and go into the library, we have an entire section called Everything Green. In that we have an area called scripts. And the scripts are in there for the questions to ask of your seller, of are they leased or are they owned, so that you know how to ask the questions when you're going for the listing.
Mm-hmm. And it's usually fairly easy to get a copy of that lease too. All right. Conventional loan limits, just quickly, there are different conventional loan limits in Worcester County. Right now it's $510,000. That's up from say 5 years ago, that loan limit was $417,000. So if you see that shift of almost $100,000, that's incredible. So basically, what the conventional loan is, that loan amount, not the purchase price, the loan amount has to be below $510,400. Okay. If we pop above that, what we get into is jumbo and non-conforming loans, or also called non-conventional loans. Okay, what you need to know with this is these loans are a little bit more critiqued. It's going to be higher purchasing prices. That creates a lot more of a liability. So the buyers on that end are going to be, the underwriting process is going to be a little bit more secure. And there's going to be, the main thing is they're going to need more than a 3% or a 5% down payment. There are programs that we do 5% jumbo loans, but usually the rate's a little bit higher. So you're looking at probably 10% for a jumbo loan. So again, a jumbo or a non-conforming or non-conventional loan in Worcester County is anything over $510,000. FHA loans, everybody's favorite, my favorite. Everybody likes to talk about FHA loans. There's definite pros and cons. I love FHA loans. I think that they're fantastic for people who are, have a lower credit score and looking to actually, achieve the dream of home ownership, right? So with the FHA loan, down payment, no matter if you're first-time home buyer, second-time home buyer, 20-time home buyer, 3.5% is the minimum down payment, okay? The rates are definitely better. The reason is FHA loans are government-backed. So they have an extra layer of security through them, through the government. So what that means is there's less liability, and what that means is there's better rates for FHA customers, okay? The drawback is that the private mortgage insurance, no matter how much you put down, you're going to have private mortgage insurance, okay? That private mortgage insurance is ranges. It's usually less than 1% of the loan amount. So if you think about it like this, if somebody's buying a $200,000 home, the private mortgage insurance is pretty much less than $200, okay? So great for somebody who's looking at an alternative from conventional, because their private mortgage insurance with conventional could be $400. So, it depends on the actual buyer. We're much more lenient on the credit scores. Like I said, we can go down to actually a 580 with FHA, which we just picked that up last year, a new program, a new investor. Prior to that, it was around 600, 620. We can go down to 580. It does have a couple of other circumstances that they need to meet, but we can do it. Owner-occupied homes only. And that's not necessarily true, because it's the way that it's read is a little bit different. You can buy a 2 to 4 unit with FHA. It's a great opportunity for especially first-time home buyers that are looking to create a little bit of wealth for themselves. And you can get into an FHA multifamily for 3.5% down and then use that rental income to supplement your mortgage. Okay, so we do look at that as income. So if somebody's pulling in $2,000 from those other units, we're going to take a very high percentage of that and put it towards their mortgage. So what that means is that your buyer who was approved for, say, a $200,000 single-family home, maybe now could be approved for a $300,000 multifamily home. Okay, so it's a huge shift that's great to kind of have on hand in the back of your head for customers that, might have growing families or first-time home buyers. The other drawback to FHA loan, which isn't a huge drawback nowadays, is again, there's a loan limit. So in Worcester County, that loan limit right now is $339,000, which that is up significantly from the past 5 years. From last year, it's up $20,000. So there's a lot of opportunity with the FHA. We'll talk a little bit of the drawbacks with the appraisal with the FHA, because I know that's a very large concern on the realtor's end, is the overlays that an FHA appraisal has. Okay. The next loan, VA loan. So this loan's for veterans. This loan's for veterans' spouses. VA loans are, the credit score that we can go down to. It's usually somewhere around like 580, 600. The biggest draw to that is that it's a 0% down payment. Okay. Primary residence only. There's no private mortgage insurance. If you collect disability, there is not a mortgage insurance premium cost that you pay up front. So every veteran loan does have a small cost that can be financed in. If you're on any type of disability, that's wiped out. It's zeroed out. Easy, the credit, like I said, we can go down to 580, 600. For VA, it may not always be the best option for somebody who is a veteran, right? There's a lot of benefits to it, but if I have a veteran that says I want to do VA, but, there may be one or two things that I see in their profile that I could say, well, let's look at this VA option, but then let's look at a conventional option or an FHA. So it's not only, the veterans that just go right for it. So it's nice to look at the different options. VA you have to, if you have a fiance or if you have a boyfriend, girlfriend, you cannot use them on a VA mortgage. You have to be married. So if you want to add their income in, there are other outlets that are out there for mortgages. If you do have a VA buyer that's not married, we can look into different VA products, but for specific VA, you have to be married. The biggest thing with VA is that you have to have DD 214. So it's basically the paperwork that shows that you were a veteran. Okay. Any questions on the veteran loans? Pretty straightforward.
Well, unless you want to explain a little why it's difficult for the real estate brokers. The things that are asked for compliance, like,
See, I don't ever see that.
well, chipping paint and...
Oh, on the appraisal.
Yeah.
Yeah, we'll talk about the appraisal
Okay.
afterwards. Yeah. USDA loans. Again, 0% down. Better credits, better rates. The thing with USDA loans is it's formatted for farming and agricultural use, okay? So in Massachusetts, there's certain areas that just won't qualify. There's a map down below here, which you can see all the green, the light green, is eligible, which is, it depends on the actual property address, which is very easy to look up. There are a lot of higher standards to make it sure it's eligible. So even though it is in a specific area and it says that it's eligible, if the house is more than, 2,000 square feet with, 6 outbuildings that are just enormous, it may not qualify for USDA, even though it says it is. So that's something that you'll just want to check in with us. If you have a customer or buyer that's looking for USDA primarily, make sure that they can get approved for that mortgage. Okay, that property can get approved for that mortgage. Yep.
Grandfathered properties, farms, things of that nature. So right up the street, I sold a grandfathered horse farm behind the grocery store and Texas Longhorn and stuff backside behind it. That was a grandfathered farm, a horse farm. Is that a property that, even though it falls into this white category because it's a grandfathered farm, might it be eligible for a USDA? I just use that for an example.
It could be. I think that, so the eligibility is probably grandfathered in from the town, right? So on the mortgage end, it could qualify for a USDA. The fact that it's grandfathered in from the town is a completely kind of separate entity from the mortgage.
So it might not affect whether or not you're a viable candidate for that loan.
Yeah.
Okay.
Yeah. Just like I know in Marlboro, a lot of homes that have in-laws are grandfathered in as a single-family home, right? But however, on the mortgage end, they're multifamily homes. They're 2 units. So that's a great case where, even though it's grandfathered in with the town, how a mortgage looks at it, could be a little bit different. Okay. Credit scores. So credit is one of those mysteries that I've been doing this 18 years, almost 18 years. There's some credit reports that I see that I just don't understand why your mortgage or your credit score is so low. Of course, there's a lot of different factors. The biggest factors that come into creating your actual credit score, your payment history is huge. That's the biggest chunk. So with your payment history and the amounts owed. So usually they like to make sure that your payment history is consistent. We like to see no lates in the past 2 years, especially on mortgages. Okay, if it's credit cards, we're very lenient on that, except if it's for 2 years straight. Okay, so as far as if you have a late on your mortgage or 2 lates within the past year or two, it could affect it a little bit. If there's more than that, it's going to severely affect your somebody getting approved. The length of history, the length of time. We see a lot of people coming into the U.S. that have just started credit. If they don't have a credit history of more than 6 months, chances are we're not going to be able to finance them for a mortgage. They like to see at least a 2-year history of credit. So if you have somebody who, is a college student or just really hasn't had any credit, they need to kind of build that up. And the crazy thing is having more credit cards and trade lines actually is viewed better on our end because we can see a history of repayment on those as long as they're low, as long as you don't have $1 million in debt. But yeah, we like to see that history of borrowing and repaying. That really affects your credit history, but it affects us as well. New credit, you usually get dinged on your new credit within the first 30 days. If you open a new credit card, it's going to impact your credit score. I will tell you, though, with mortgages, it's the one great thing that the credit companies are aware of is the fact that when you're applying for a mortgage, they don't ding your credit report hard. It's usually 2 to 5 points. Within the next 30 days, it regains. Okay, so if you have a buyer that says, I don't want to pull my credit because they think it's going to drop 20 to 30 points, that's not true. And you can have your credit pulled by a mortgage company within that 30-day period, and it's not going to affect their credit score. It just affects it once. Okay. Different types of credit. So installment loans, like auto loans, credit cards, student loans. Having more of a variety of those helps your credit score increase. So the one thing that I do want to talk about too is we work specifically with a company that we help buyers increase their credit scores, which is an incredible tool for me on my end, not just saying, oh, I'm sorry, your credit score is too low, bye. First of all, I would never do that. And second of all, we put a plan of action in place, right? So we're talking to the buyer and figuring out, okay, well, here you are now, but let's work on a game plan. Let's work on a credit game plan. And usually that game plan can be 3 months to 6 months to 12 months, okay? I have had incredible success with this. There's incredible success stories with people, rebuilding their credit and getting themselves to where they need to be. As long as they want to do it, we will help. So there's never a no, right? It's never a no. It's always, let's work on it, let's figure it out, and then it happens.
This is an invaluable opportunity to help you build your relationship with your client because of Sarah working on this. Because sometimes they're at a total loss. They may know that they're in trouble, but they don't know where to begin. And sometimes it's as simple, and you can talk about this better, as to knowing which credit card needs to be dealt with first that'll better bring the score up or whatever. Mm-hmm. And they're so thankful for that guidance.
Yeah, there's a lot of times I will hear people say, well, I'm going to pay down some debts before I come talk to you. No, it's the last thing that you should be doing, okay? People think if they have very, very high debts, there's no way they're going to qualify for a mortgage. You might not want to personally, you might not personally be ready for a mortgage, but on our end, I'm looking through your credit report and figuring out, and just like Susan said, picking out, okay, if we do need to pay off debts, maybe we pay this one and not these ones. Where, they might not have that knowledge, because there's two different ways to look at it. One is, okay, what's going to make you feel better, personally, but the other one is what's going to really increase your credit score. All right, so we need to, when you have buyers that are kind of timid about that, have them talk to us. That's the first step. I have so many people that have been scared walking in and say, I don't know what to do. And I said, just come and talk to me. There's no judgment. This is like, we figure it out. We help. And that's what makes this job so exciting, is, it's actually helping people and getting them into houses. So take advantage of that. Make sure that if you hear buyers saying that they need to work on their credit, it's not necessary. We'll tell them what to do. We're the experts at it. We'll tell them what to do. Okay. Low credit scores. So how does this affect your mortgage? How does it really affect your rate? So if you're looking, the 740, we call it a FICO score. It's really, your credit score. FICO is actually a brand. It's compiled of the three major bureaus: Equifax, TransUnion, and Experian. So with your FICO score, how it affects you. You have a 740 and above, you're in the top tier, like I said, okay? If we're going down the scale, your credit score is going to, your rate is going to go up a little bit. So 720 to 700, 680, 660, 640. This chart is for a conventional mortgage, okay? So you're going to see a big jump if you're at a 640 score and you're going into a conventional mortgage. If someone came to you with a 640 score, I would say let's look at FHA. Okay, because that rate's going to be much, much lower. Okay, how it also affects is your private mortgage insurance. Private mortgage insurance is compiled of the amount of money you're putting down, your credit score, and how much your loan amount is going to be. So, and it works off of percentage. The biggest factor is your credit score. So the lower the credit score, most likely the higher a private mortgage insurance cost would be in a conventional mortgage. However, like I said, there's some programs out there that have a set private mortgage insurance rate, so it doesn't necessarily mean that it's a bad thing for somebody who has a lower credit score. But just know when you have a buyer that their credit score is a little bit lower, it does affect the overall payment. It affects the overall rate. Documentation needed. This is the most important thing. I mentioned this in the beginning. If there's one piece of advice you could give to your buyers, or it could be, obviously I say buyers, but it could be your sellers transitioning into buyers. Documentation is the start of the pre-approval, and it's everything. If there's missing documentation, I do not feel 100% comfortable giving a pre-approval letter. So if you're missing one page of your bank statement that I can't account for.
Can you talk about the blank pages?
In bank statements?
Make
Yeah.
sure you put them in.
Yeah. So in bank statements, if you notice, being old, we need to obtain pretty much old school bank statements. All right. So you'll see on the bottom of your bank statement pages, it's page 1 of 10, page 2 of 10, page 3 of 10. If you notice in your bank statements, there's blank pages. So you say, I don't need to send that to Sarah. Guess what? I need that. I need that blank page that says page 8 of 10, 9 of 10, 10 of 10.
Even if it's blank?
Mm-hmm.
Just because paper path?
Yep. Mm-hmm. Bank statements are the things that trip every buyer up the most on my end. So I usually just tell people, go to the bank and have them print them out for you. So, I say that up front too, so they have that expectation that this is what's going to be needed. But documentation, like I said, if you are saying, oh, Sarah, where's my pre-approval? And I say to you, I don't have the last pay stub. Don't be mad at me. I'm not going to give you a pre-approval letter without seeing that pay stub. It's just not worth it. Like I said, it's not worth me not being able to review it, sending you out there with a pre-approval or pre-qualification letter that I can't stand 100% behind, and then you wasting your Saturday. I don't want to do that. So just make sure that when your buyers are saying, oh my God, I have to give them, everything under the sun. It's not true. We require a lot less documentation nowadays. Usually it's 1 year W-2, 1 pay stub, 2 bank statements, and a copy of your license. It's not too bad. Restrictions have definitely gotten a little bit more flexible with that because we have certain things technology-wise that we can utilize rather than actual documentation.
Before you move on, can I ask you a question going back to approval?
Yeah.
I've been noticing lately that I'm starting to see this thing in the FICO, all 3 of them, but mostly Experian, I believe, of this boost.
Oh, the Experian boost
Does that affect this at all? Is it even something, if somebody brings it up to me, should I go ahead and do the boost? Because I know that it involves tapping into your online statements for electric, whatever.
Yeah.
Does that have any kind of relevance to this process whatsoever, in case it's asked?
So, going back to the fact that everybody's a marketing company, this is a marketing tool, okay? There is a program that I have that basically does the exact same thing in a much secure format. Like I said, if you see anything marketed out there, people spend millions and millions of dollars on marketing, especially mortgage companies, some of the big names, saying they can do this and this and this and this. We can do all of those things. It's just we're not, spending $1 million telling people we can do things and then doing a bait and switch, right?
If you have a question about it, ask for us first.
Yeah.
Before your client gets in trouble or something.
Yeah, 'cause I've seen that happen way too many times. And also, because they spend more money on all of that marketing, their rates are higher. So you'll see, you will get used to, if you're working with us, you will see that our rates are going to beat everybody out there.
Can you talk a little bit about, I noticed one of the things was the no 2-year work history. Talk about contract work or 1099s, I don't know.
Yeah,
all those different things that come
So
up.
self-employed borrowers are always, that's when my ears kind of perk up, and I'm like, okay, we got some extra work to do. 1099 employees, contract employees. We like to see at least a 2-year history of earnings of that. Contract employees, I don't even kind of want to get into that because it can create it's a whole different area of things. They have to have a history of a contract, and then they have to have a forward contract.
Commitment.
Yeah.
Okay.
In some particular cases. But when you come across a self-employed borrower, 2 years history. That's going to be the safest bet. Okay. Could we do it that's shorter than that? Yes. Is it going to require a much bigger down payment, a different mortgage product, and a rate that's crazy? Yeah. But why not just wait the 2 years? Okay. What else is on there? Student loans are a big thing nowadays. If I have someone that I've been working with, they have, $225,000 student loan. Some have $70,000, and we have to factor in those payments, which is brutal. So if we have student loans that are income repayment, we can use that income repayment amount, which is nice, per month. Gift funds. It's become a lot lax on gift funds within the past 3 to 5 years. Beforehand, it was it was pretty difficult, but pretty much anybody can get a gift nowadays. Right? It has to be, we like to see it has to be a relative, or someone that has a very strong.
And with no repayment, is that what you have to say?
Mm-hmm.
Can you explain that?
So there can't be, so a gift is essentially what it has to be. It has if my, say my aunt or my uncle gave me $10,000, right? What has to happen is we sign a gift fund letter. This letter states, I am giving Sarah Baer $10,000 for the purchase of a home. There's no repayment that's going to be necessary. You both sign it. Boom, we put it in the file. We document that with the funds being received. There's your gift. If there can't be a repayment. So it can't be, we're going to put a second mortgage on your house, or you write on the gift letter, Sarah has to pay me $25 a day, or something like that. It can't be. 401k. You can use 401k funds for your down payment. I've come across people within the past year that don't know that, so it's good to at least mention. Taking equity out of your car, you can use that. Credit card, taking money from your credit card, you cannot use that. So if you do a money transfer from your credit card, that is not acceptable. Okay, it has to be tied to something. So a car works. Yeah. When can you get a mortgage again? This is still, back 7 to 10 years ago, this was, a huge factor. If you foreclosed or had a bankruptcy or, because the way that the market was going. Again, we've become a lot more lax on the timeframes of this. So if somebody comes to you and say, I had a bankruptcy, but it was, 10 years ago, they're fine. There's different bankruptcies. There's a Chapter 13, a Chapter 7, Chapter 11 bankruptcy. If you have somebody questioning these timeframes, just ask. I don't think that's even in your thing, but I just put it in here because I thought it was relevant for you guys, just to have an understanding and have you be aware. It's not something where we have to wait 7 years now. It could be 2 years, it could be 12 months, it could be 4 years. There's it's become a lot lax. Home affordability. On our pre-qualifications, we pre-qualify for an actual loan amount, right, or purchase price. But realistically, what we're doing is we're pre-qualifying your buyer based on monthly payment. Okay, so if Susan comes to me and she says, Sarah, I want to get pre-qualified for $250,000. Okay, great. Well, a $250,000 mortgage in, say, Marlboro compared to Cape Cod is going to be completely different because the Cape, the taxes are only about $1,000 a year. In Marlboro, they're about $5,000. So she could afford maybe $250 down there, but maybe not $250 here. It might be $175 here. So it's good to know and understand when someone says, or you have a pre-qualification letter that says $225, check with your loan officer, check what that monthly amount is, make sure, and the buyer should know this. This should be education spread, I'm just saying if you're not working with Ross, this has to be kind of top of mind for you because not everybody in the mortgage industry works this way.
This is why it's so important to have your clients meet with the loan officer so early on, because in the state of Massachusetts, the taxes are so different from town to town. They could be $11 a thousand in one town and $22 a thousand in another town, and that changes your monthly payment drastically.
Mm-hmm. Yeah. Just as an example, I'll give you kind of a quick example of how we calculate what you can afford. I don't know if anybody really knows it. It's not a huge trick. Basically take your monthly income. We'll use $10,000 for your monthly income. We can use 50% of that, like I said, to cover your debts in your mortgage. So that basically, I would say 50% is the max. I would say, 45% is a really good number, okay? So say you make $10,000. I'm going to use 45% of that to cover anything that appears on your credit report, which means your minimum monthly payments. So you could have a credit card that has $100,000 mortgage or $100,000 debt on it. If your monthly minimum payment that you have to make is $50, that's what we're calculating in. Okay? So again, $4,500 we can use. All of your credit, anything that's appearing on your credit report, your credit cards, your auto loans, your student loans, they all total $1,000. Okay, so now we can work with $4,500. Your credit report has $1,000 minimum monthly payments that you have to make. We only use what's on your credit report. We don't take into account your electric bill, your cell phone bill, anything like that. That's where the Equifax things comes into. It's a little bit. I wouldn't suggest somebody doing that because now that's going to appear on the credit report. So now left over we have the $4,500 for credit. Now we have $3,500 that your borrower can be pre-approved for a mortgage. Okay, so that. Then what we do is correlate that and to figure out what that purchase price would be. So $3,500. a month mortgage payment, you know, somewhere up to $750,000, $1 million. But again, coming back to the fact that we're approving them based on their monthly repayment possibilities. Okay.
And can you also talk about the property insurance? Is everyone asking for 12 months in advance?
Homeowners insurance?
Homeowners
Yep, so
insurance.
that comes into closing costs. Closing costs, I always say roughly to ballpark it, give your buyers, I'd say 3%. 2.5% to 3% is what to bank on. That involves closing costs and escrows. Okay, so if you don't know, closing costs and escrows are two separate things that the buyer has to pay for out of pocket at closing, in addition to their down payment. Okay, I lump them into just closing costs because I think it's an easier way to explain it. Some marketing companies will say, we'll pay all your closing costs, which could be $1,500, but then you have your escrows, which are $6,000. So then you get kind of duped, you know. So your closing costs, they include any work that's put into the mortgage, you know, the appraisal, the credit report, the attorney fees, the recording fees, any work that gets put into it that's paid out to a third party. Okay. Then you have your escrows, which you have to pay up front. So if you're buying a house, you need to make sure that your taxes are going to be paid and your homeowner's insurance are going to be paid. What that requires is usually 3 months of taxes up front and 12 months worth of homeowner's insurance. The reason being is, well, in Massachusetts, your taxes are collected quarterly. So we need 3 months up front to make sure that payment's going to be done. Your homeowner's insurance is paid yearly. So we need to make sure that that's paid up front. So if you're getting a mortgage, when you get a mortgage, every month you're making your principal and interest payment 1/12 of your homeowner's insurance, 1/12 of your taxes, right? So if your taxes are per year are $12,000, you're only paying $100 a month. So your buyer has to be aware of what is needed up front to make that, to bridge that gap of the closing costs and escrows. Okay, so every month they pay in. When the taxes are due, we pay them. We pay the town. When the insurance is due that next year, we have enough money collected over that 12-month span that we can pay them. So your buyer is always going to be one step ahead of the game with their escrow account. Okay. Okay, the fun part, appraisals. FHA appraisals and VA appraisals, they're much different. I want to say much different. They're different than a conventional appraisal. If you have somebody that's getting a conventional mortgage, all you realistically need to make sure is that the home is safe and it's habitable. With FHA and VA, because they're backed by the government, there's certain criteria that needs to be met. Okay, so it's a lot of different safety codes need to be met. The biggest thing that we see on we'll focus on FHA because VA is basically this. It's basically the same, wouldn't you say? It's a little bit
harder.
Yeah. So with FHA, the biggest issues are peeling paint. So if you have peeling paint on the house, any outhouses or garages, that will be flagged and most likely will not be eligible for an FHA mortgage. Okay? Cracked windows, stairwells that don't have railings, electric and heating systems that are basically on their way out and have less than like a 2 to 5 year lifespan on them. The appraiser's looking at all of these things, okay? The life of the roof doesn't come up as often as I would think, but it does come up. You got to make sure that the roof is at least, again, has 2 to 5 years left on it. Proximity to gas stations. This is a big one that everybody forgets about with FHA. It can't be within 100 yards of a gas station. Huh? Yeah, I know. Yeah, there was a guy who he was buying a multifamily, and we could only go FHA, and once we did the appraisal, it came back.
So a good point about that, I was just thinking about the age of the furnace and things like that. If when you're meeting with your seller, the seller can line item out to you the year that he updated this or the year that he updated that, hoping that those are good answers, and you can hand that piece of paper to the appraiser, it certainly helps the appraiser out an awful lot to know that those things were updated, so he doesn't have to wonder.
I actually keep a sheet for that.
Mm-hmm.
And
Yeah.
I give it to them and have them go through it completely, check off, put dates, whatever they need to, and then go back over it with them before they, and it's kind of a
That's
handy.
great to do.
It's also good to, I mean, it's a seller's market nowadays, so you might not care as much, but it's good to have that knowledge, because now you're opening up the home to every single buyer that's out there. If it is, if the boiler needs to be replaced and you know that, and it's going to cost you, $600, $800, is it worth it to your seller to now open up a much different criteria of buyers? Yes.
I have to know, what's the point of proximity to a gas station? To a safety feature?
Safety.
Lust reports also, right? Leaking underground
Yep.
storage tanks.
Mhm.
There's-
So what is that, like 100 yards or, okay.
Also, if you have a well, you do need to get that tested for water. So it does require, they just changed that actually, that it is now officially required.
So it's quality and quantity. And I
So you have to do,
flunked that.
yeah.
When I sold my house, I flunked it and I had to install a new well.
Yep. Yep.
Not fun.
Yeah, no.
That was a VA loan.
Yep, so VA loans, the other thing with VA loans is that you have to have a termite inspection. Have to.
Which the
Buyers.
veteran cannot pay for.
No. The veteran cannot pay for it.
That's right.
Yeah, so there's just some, there's a whole lot that goes into, so a whole lot that goes into this, right? So if I have a buyer that comes in with a 640 credit score and they want to buy this home but it has a peeling paint, there's no other option for them really, so it's, and with the appraisal too, I will tell you, just briefly talking over appraisals, I don't know what else we have. Briefly talking over appraisals, when it comes to the amount that the appraisal comes in at. So say you have a FHA buyer and the property is selling for $200,000. If the appraisal comes in at $195,000, there is zero negotiation with the sellers. The seller has to either come down to $195,000 on FHA only, or the buyer walks away. Okay? If this is a conventional loan, and the home is selling for $200,000, the appraisal comes in at $195,000. There's the option for the buyer to come up with the remaining $500,000 or $5,000. The seller dropping the price, them meeting in the middle, or some type of contract, or the buyer can walk away as long as there's a mortgage contingency or an appraisal contingency. So just something, to be aware of, if you're taking out a buyer, they have a VA loan or an FHA loan, these are good things to kind of have in your head and to acknowledge. What's the difference between a mortgage broker and a mortgage bank? Does anybody know this?
No.
Okay, well, I'll tell you. So as a mortgage broker, so I basically work with 40 to 50 different banks, 40 to 50 different investors. So I have my hands in wholesale rates. This is getting a little bit more into it than is necessary, but I think it's relevant for at least this year to be aware of this. I said this last time we met Susan last week. This year is going to be a refinance boom, okay? And what's going to happen with a lot of banks and a lot of credit unions and a lot of people that are really just hungry for money are going to concentrate solely on refinances. What that is going to do with buyers, people who are actually purchasing a home, is putting them on the back burner, because refinances are easy money, easy. But banks are going to get completely overwhelmed. Right? Ross Mortgage, we have the foresight to understand the mortgage industry's ups and downs. And our focus is and always will be purchases. Purchase comes first. It's just the way that it is. It's somebody's biggest investment. We want to make sure that they're first in line. So the reason that I put this in here is that basically a bank or a credit union, they're typically not licensed loan officers with the state of Massachusetts, okay? So they don't have the knowledge, they don't have the criteria. They've built themselves up from the bottom of the bank, right? They were, not the bottom, but the tellers. They became a teller, then they became consumer loans, and now they're in mortgage originations. We have to become licensed just like you guys. We have to keep our licenses. We have to make sure that we're doing the right things, right? With that being said, is that we understand the mortgage industry. It's all that we do. It's all that we do. So you saw that crazy chart that I showed you before. We're used to that nutness. Mortgage banks and credit unions are not. I used to work at a credit union. I left there within 2 years because I just saw so many people getting denied for loans because they only had 3 products. They had 3 mortgage products. And that's the majority of banks and credit unions around here, is that they really only have 3 to 5 mortgage products. We have about 20 to 30 mortgage products. You know, when I highlight some of these products, there's so many other products that fall under that umbrella. So it's giving a better opportunity for your buyers to get into a better program. It's giving you more of an opportunity to make sure that your buyers are taken care of, that they're closing on time, that they get their commitment on time. And also, our rates are most likely always going to beat a bank. It's just the way that it is. Some people are loyal to their bank. That is fine by us. I just know that they're not getting the best rates. And I will talk a little bit about the way that how they price the rates and their closing costs. And this is not negative on them. It's just me giving you the education and knowledge, because collectively, we want to make sure that the buyers are getting the best deal, right? Closing costs. How banks and credit unions work is they'll usually give a rate of, say, 4%, but then they will hide some of their points or secondary market fees or origination fees in the closing costs, okay? And a buyer may not even recognize that. And it's sad. And it's, you know, when I worked at a credit union, I'd be like, go somewhere else. Like, this is not a good deal for you. I'm probably going to get in trouble for that. That was many years ago, but it was, you know, I saw it. I see it still today. So just giving, you know, you obviously care about your buyers, right? You care about your sellers. You want to get them the best deal. You're doing them a disservice by not giving them options and telling them where to be looking, right? And I will 100% take a look at, you know, I tell them what documentation to get. If they're getting a better deal somewhere else, I have never once said, you know, no, you can't go there. I would say, go ahead, try it. I go, but you got to go lock in today and see what they get. And they usually call me back and say, no, they can't do it. So just be aware of that. List reports, you know, I was going to talk a little bit about this, but I don't know do you want me to talk about list reports? Sure. Okay, so list reports this is a great tool. Shauna, you could probably speak a little bit about this. Where it comes in is especially for newer agents or somebody who really just doesn't have the time to create a whole marketing plan or, you know, spend their time, you know, on Canva, creating all this stuff. List reports are basically, it's a marketing rockstar team that we pay for and we give to you guys for free. It comes with 25 different pieces of marketing material, from open houses to just listed to just sold. It's a click of a button. And if anybody isn't using it, you're crazy not to. There's no reason not to be doing it. You do absolutely nothing. You have a house that you're listing. It's great for listing agents, but the one thing that I think that people don't utilize it enough is for, you see a house that you like that another realtor is selling, you could put your information into this and pop it onto social media, and it comes across so clean and clear and nice. And people are now you're marketing, you're marketing another realtor's property, but people see that house and they call you because they like that house. So it's the more that you can do this, and if I suggest sitting one-on-one, spending like probably 25, 30 minutes. I can kind of show you all the ins and outs of this. And like I said, it's very simple. It's very easy. Shauna, I know that you've used this many times. Shauna does postcard mailers. That's an option that we can do out of this list reports. You can definitely obtain leads if you want to. Okay, the way that you obtain leads is you basically are putting your information out there. There's a list code. You create it yourself, whether it's, Shauna Sells or, whatever, where people do text you. And you do get these leads. They do come in. So it's something that I feel that if you're not using it, you're missing a huge step.
So another part of that, and we have the entire Spiral book out here if you'd like to look at it, the infographics are wonderful. If you're doing an open house and you've got people walking in who are new to the area, the infographics will tell about the community, about the schools, about the restaurants. So it's just giving you more information than just the details of the house.
Yeah, it's pretty cool to look at. I like looking at them. They're great if you have, it's basically if you have a potential listing that you're working towards and you go and you do the whole LAER presentation. This is a great add-on to that because you're now saying to that seller, that potential seller, hey, listen, I create this marketing plan for you. I put this all over social media. LAER sends it out. I create your own website. I send that to you. You can share it on social media. We basically broadcast this everywhere. So it looks like you've done all this work, where really you haven't. And it comes out looking real nice. This is just some of the pieces that you'll see over here. Yes, Shauna?
This is actually for Craig. There is a sheet that you can print out that is the green sheet.
Yes.
Which says that this agent has chosen to not print out a lot of paper documents to hand out, and that there may just be one or two items on the table for everyone to share, but they can take a picture of the notice and then get all the information to their cell phone.
Excellent.
I always put that up. It's
Excellent.
wonderful.
Yep. I love list reports. I will tell you that potential buyers love them. I bring them to the open houses that I go to. People grab them and take a look at them.
And the shareables.
Yeah, the shareables. So I don't really see shareables on my end. Even though I subscribe to list reports for everybody, I don't get to use them. But I see them. I see Shauna post them. I see other people post them. It's a created social media shareable.
It's beautiful.
It comes up where you can just, it's extra, tips of the day or, content, social media content that's at your fingertips that you just can throw on social media.
Thank you.
And people love it.
Yeah.
I mean, people comment on it and they give you ideas on what to say, and so you don't even have to think. It's National Pizza Day.
Exactly, today's National Pizza Day.
Yes.
List Reports has awesome leads. When you order the postcards, not only do you send out the postcards, but you get a CSV file for Excel that lists out where it went. And there are phone numbers and email addresses and actual addresses. And let's say one of them comes back, you still have the address. If you do renters, you still have the address, and you can just change it, resend something else back out.
That's excellent.
To say your current occupant, and they'll get it. So that's my very first source of leads as an agent in my first year.
Yep.
And I think it cost me maybe $100 for the whole year
Yeah.
to get a whole database full of leads.
It's fairly cheap to do it that way too. Yeah.
Yeah.
All right. I think that's all I have.
Thank you very much, sir.
You're welcome.
Thanks, sir.
Yeah, you're welcome.
Great.
Don't forget to mention your podcast that you.
Yeah. You can go, everybody can Facebook me in my mortgage nerd video.
We're still on.
Sarah Baer.
Yeah.
So thank you, Sarah, for being here. Just wanted to give you a little bit of a sneak preview for next week. On Monday, we will be talking about objection handling, and Ann Silverman will be with us. She's excited to be talking about that. Tuesday, we have a guest appraiser coming, and we are also going to be talking about appraisal versus CMA, so we will talk about CMA and RPR. Wednesday, we have Tiger Home Inspection coming to go over everything soup to nuts that you want to know about what a home inspector does and all that's involved in that. Thursday, we have Craig Foley coming, talking about everything green. So it's going to be an exciting week next week, and we hope that everyone will join in and look at the recorded videos when they get on our YouTube site. Thank you and have a great weekend.